Hello and welcome to the Hustle to Achieve podcast. On today's episode, we are joined by Brian Feroldi. Brian is a financial educator, YouTuber, and author. He started his investing journey in 2004 and he has written over 3,000 articles on stocks, investing, and personal finance for the Motley Fool. Brian's book, Why Does the Stock Market Go Up, was published earlier this year in 2022. Thank you for being on the podcast, Brian.
Pleasure to be here. Thanks for having me.
Can you please tell us about your investing journey, how you entered into the financial world, and what were the initial, your initial experience? What was your initial experience in the market?
Sure. So to your point, I got started investing in 2004. That just happened to be the year that I graduated from college. And despite having graduating with a degree in business, my financial education was essentially just to the right of zero at the time. I knew very, very little about money, about budgeting, about how the stock market worked, about investing, about the tax advantages. None of that. I didn't have an entrepreneurial mindset. I was a product of the education system that trains you to think like an employee. In 2004, the moment that kind of changed my life was when my dad, as a graduation present, handed me a copy of a book called Rich Dad, Poor Dad by Robert Kiyosaki. I devoured that book. I read it cover to cover in a few days. And while looking back, I don't think that that's the best book. And there are things in that book that I now disagree with. It was the very first book that I ever read that introduced some very important money concepts to me. Things like the rich think differently about money than the middle class and the poor. You can build wealth in one generation. The differences between assets and liabilities. Why investors focus on passive forms of income and the different types of income, how legal structures can help to minimize your taxes, the difference between income and cash flow. All of those top topics were brand new to me, just completely brand new to me. And for whatever reason, my personality is just naturally attracted to everything related to money, investing, and personal finance. So after reading that book, I've just been on a never-ending binge ever since to find content that relates to money, to personal finance, and investing, and just devouring it. I started putting money into the market in 2004, primarily doing so through my company's 401k that I worked for. And beyond that, I was investing a few $100s a month into the market. In the start, I had absolutely no idea what I was doing. I was very attracted to what I thought were the fastest way to build wealth in the stock market, which was penny stocks. So I was trading penny stocks without doing any research on the companies or the businesses at all, and having no idea really how the market works. You can probably imagine what the end result was. I lost a lot of money very quickly because I had no idea what I was doing, and I was buying absolute garbage. But over time, my investing philosophy has since evolved. And after reading lots of books, connecting with other smart investors, and studying under David Gardner through the Motley Fool, I've gradually shifted to become the investor that I am today.
So you just mentioned that you started investing in penny stocks, right? And I think a lot of us, when we're starting our journey, we're really interested in 10xing our money, 20xing our money right off the bat, right? And that is why many of us are caught up in this loop. We need to find these penny stocks to invest in. So how has your thesis changed over the years? And do you still consider, I mean, obviously penny stocks are not worth investing in for the most part, but do you consider even even a slightest bit of investing your money, or would you say that should people consider investing in penny stocks, even just a part of their portfolio?
Yeah, it turns out that there's nothing quote unquote wrong with penny stocks, right? A penny stock is simply a company that has a share price below, let's just say $5, throwing it out there. And most penny stocks have share prices below $1. There's nothing necessarily wrong with the share price itself. There can be some great investments out there that are trading for $1, $2, whatever. However, a very high portion of companies that are trading below $5 per share are awful businesses. They're just awful. They're awful businesses. So the businesses behind those stocks are terrible, and they are just not built for creating shareholder wealth. So I would say the pool of investments that trade below $5 as a general rule is a very poor pool. Now, there are some superstars in there. There are some good businesses in there. So as long as you are investing in that pool with the mindset of looking for high quality businesses, I think you could actually do well by investing in some penny stocks. And just a very simple criteria is to say, eliminate all penny stocks that are unprofitable. Boom. You just eliminated probably 95% of companies out there, and the list that you are left with is worth sifting through. So there's nothing necessarily wrong with penny stocks themselves. It's just the pool that you're fishing in is a poor place to invest.
So let's say, I think there's a thesis when you're investing or when you're researching for a particular stock. Would you say we can apply the same or similar thesis when we're researching for penny stocks, or would it be different for, like, let's say when we are investing in blue chip stocks or value stocks? Would it be similar, or would it be different altogether?
Yeah, the most important thing is to back up and say, why does a business go up over the long term? What is the thing that fundamentally makes a stock more valuable 1 year from now, 3 years from now, 5 years from now, 10 years from now? The answer is always the same thing. The underlying business becomes more profitable. The underlying business behind that stock becomes more profitable. How does it become more profitable? It tends to dramatically grow its revenues, enhance or improve its margins, and that leads to outsized growth in net income. If you take a company today that's trading on the market, and this year it makes $1 million in profit, and 5 years from now it's making $50 million in profit, I can be pretty darn sure that company, the stock, the price, the value of that company 5 years from now is going to be dramatically higher than it is today. So whether you're fishing for large cap companies, mid cap companies, penny stocks, or small companies, what I'm after in all cases is a reason to believe that company can dramatically increase its market value over long periods of time. And the way that I find that out is by, I did a very simple exercise, which I recommend everybody listening to this do if you're investing in companies. Step one is to write down, make a list, a comprehensive list of every attribute in a business that you are attracted to. If a business had this characteristics, that would be a positive in your mind. For me, that's things like, I want a balance sheet with lots of cash and no debt. I want a gross margin to be stable and rising. I want the company to be profitable, free cash flow positive, and high returns on capital. I want the company to be in an industry that is rapidly growing. At the same time, I want the company to have a competitive advantage that is durable and long lasting. I want the stock to have already beaten the market. I want a management team that outperforms expectations, et cetera, et cetera, et cetera. I have a list of like 30 criteria that tell me this makes this business attractive to me. So that's step one. Step two, make another list. All of the criteria that you don't want to see in a company. Like if a company had this attribute, it would be a negative. So for me, that's losing money. I don't like it when companies lose money. Accounting problems. I don't like it when a company has accounting issues. I don't like it when a company gets an outsized portion of its sales from just a few customers. I don't like it when the industry is being disrupted. I don't like it when the company is dependent on gold prices or commodity prices or interest rates, etc. So I've got these two lists: good list, bad list. Then I forced myself to rank the criteria from most important to least important. That is a very, very useful exercise, because it's one thing to say, I want a company with A, B, C, D criteria. It's another thing to say D is the most important, B is the second most important, A is the third most important, etc. But I really think that process, no matter what type of investor you are, is very, very useful. Finally, so I have these two lists, good and bad, ranked in order and weighed. And then I assigned 100 points to the criteria that I think is most important. It has to be an exact number. It doesn't matter if it's 10, 100, 1,000, whatever you want, but you have to pick the number ahead of time. So I chose 100, and then I doled out 100 points to each of the criteria according to my weighing system. And when you're out of points, that's it. Do the same thing for the negative system. Finally, after all this process is done, I have created for myself a scoring system, a checklist that I can take any company through, any business, regardless of its price, its market cap, its location in the world, etc. And this checklist will tell me how strong of a match is this business in its current form for my investing style. And then I do this process over and over and over again. And I now have a database that has hundreds of companies in it where I've matched up those companies to my investing style. From there, I put my capital and my money into the companies that are the best fit for me, and I avoid the ones that are a bad fit.
So so you just mentioned that, there's this criteria that you follow, wherein you're looking at the financial of the company, the management of the company, and you have 30 other criteria, right? So how do you which criteria, or what are the top 3 criteria for you that you look at, and how important do you think that, because I think the only numerical criteria that we have is the valuation part and basically the profitability and all the ratios that are associated with it. And every other criteria more or less is is about the company culture, how are the employees treated, the management associated. So how do you which one do you consider is the most important out of all the criteria, and what are the top 3 criteria that you look at?
Sure. Coming up with 3 might be a little tricky, so I'll cheat and say I'll show you my top 4. How about that? So the first criteria that I'll throw out there to me is a combination of the company's business model and the relationship that it has with its customers. Let me break that down a little bit more. So to me, the best businesses out there, the ones that are most attractive to me, consistently grow their top line, their revenue, no matter what is happening in the world. Recession, they're still growing. Boom times, they're still growing. And that is a really rare trait for a company. Like in the United States, the odds are pretty good that we are in a recession right now, that we are going through tough times economically. If a company, even in this environment, can still grow its revenue 20 or 30% in this environment, boy, that's a special, strong business that has something going on. So that's one of my top criteria. And I break that down into 2 broad categories. The first is how cyclical is the company's revenue. If it's very cyclical, so if recession comes along and the company's revenues plunges, no, thank you. If a recession comes along and the company's revenue is stable or growing, yes, that is something I highly prize. As also part of that is what portion of the company's revenue is repeat purchase, is recurring in nature. I don't want to invest in businesses where they sell you something one time and then you never interact with that company again, or you never interact with that company again for 10 years. Right? That's not a business model that's attractive to me. I want something that you purchased every single day from this company again and again, or at the very least monthly from a company. So that's thing one, the nature of the business model and the relationship that it has with its customers. 2 would be competitive advantage. We live in a capitalistic world, and you can bet that if a company comes along and it creates something that the market values, other companies are going to say, hey, me too. They're going to try and do that exact same thing and steal your customers away by offering lower prices, more generous terms, some twist on it, etc. So the second most important thing, or just as important as the business model, is how can the company protect itself from the forces of competition. Warren Buffett calls that a moat. It's called competitive advantage. That's equal points with the nature of the business model for me. Third would be the company's potential, the long-term potential of it. I break potential down into a couple different categories. I want this to break down into is the company a leader in a new and emerging market? That's important to me, or a disruptor in an existing market? Does it have optionality? Optionality is, broadly speaking, the ability of a company to roll out new products or new services that create and open up new market opportunities over time. And things like organic growth. I want a company that's growing and expanding through products and services that it creates internally. I don't want it to be purchasing companies as a way to growth. So the long-term growth drivers of the business, I want to believe that the company can grow at an above average rate for 5, 10, 20 years. And then the final thing, although again, this, you're asking for my top couple, is the financials of the business. The financials of a company will prove out that essentially number 1, 2, and 3 are working, right? So it doesn't matter to me if you have 1, 2, or 3, if indeed you're unprofitable or your revenue isn't growing rapidly. So the financials kind of prove out the story that I built in the first kind of things. So I look for a balance sheet that is very strong, lots of cash, no debt, a gross margin that is stable and rising, high returns on capital, high free cash flow, high earnings per share growth, et cetera. So those are the primary things that I look for. Beyond that, I also look at what the stock is doing. Is the stock outperforming? Who's in charge? How much shares do they own? All that kind of stuff. But those are the bulk of the things that I'm looking for in a business.
So you just mentioned one criteria that was basically competitive advantage, right? Having having competition, because obviously, like, if one company comes up with something, other companies will follow suit, right? So and there are many, like, venture capitalists that are investing in startups that have similar goals or similar, like, kind of ambitions, so that probably they don't lose out on money if, like, if one company does not perform, the other one performs well. And when it comes to, like, retail investing, from a retail investor's point of view, do you consider investing in, let's say, companies that have similar, like, products or services, so that to have that basically competitive advantage? So even in terms of, let's say, market share, if two companies, let's say Pepsi and Coca-Cola, right, they're competing in the market, would you consider investing in both of them, or how would you pick one of them?
Yeah, so some businesses, some sectors of the market are ripe, are so advantaged economically that there is a high likelihood to be multiple winners in that market. One quick example is, like, should you invest in MasterCard or Visa? The answer is both. Both are amazing businesses that have amazing long-term competitive advantages that can grow at an above average rate. And the economics of payment processing are so incredibly strong that picking either, both, one or the other is a fantastic. Conversely, there are some industries that have really, really poor economics, and I just want nothing to do with them at all. One example right now is the fossil fuel industry. Right now, oil stocks are red hot. 2 years ago, they were ice cold. Nobody wanted them. Now, with inflation high, fossil fuel industry has been performing very, very well. That doesn't interest me at all. And there's a few reasons why. First off, I am convinced that in the long term, the value of all fossil fuel companies is going to trend towards zero, simply because the renewable industry, electrification, is coming and is going to rapidly displace them. Does it take 10 years, 20 years, 30 years? I don't know. I'm betting 10, but it could be 20 or 30. And when that happens, the economics of the industry are permanently disrupted to me. So I think that entire industry is uninvestable. The other thing that doesn't attract me to that industry is the fact that every single oil maker, natural gas maker out there, no matter where you are in the value chain, your results are going to be completely dependent on what is the price of oil, what is the price of gas, what is the price of natural gas. What is the market price for the thing that you're selling, even if it's upstream from where you are? That is a factor that is completely outside of every single management team's control. There's no oil executive in the world that can control the dollar price of oil. There's countries that can't even control the dollar price of oil, right? They're subject to the global supply and demand for those prices. For that reason, it doesn't matter if you're the best oil driller finder in the world. If the price of oil is tanking, your stock's going down. Right. And if you're a mediocre oil maker and the prices of oil goes up, your stock's going up. Your business is going to look fantastic. I have no ability to predict what oil prices are going to do. And picking businesses is hard enough. I don't also want to have to be dependent on luck. Working my way, or rather, I want to minimize the role that luck plays in picking an investment. So for me, everything in the oil and gas industry is flat out uninvestable.
And then you mentioned about the financials, right? So let's say there are plenty of startups that basically get their IPO done, right? And startups are usually not profitable for the only, let's say, 3, 4, 5 years, right? So do you avoid startups altogether, investing in startups, or how do you look at when you go about investing in a startup, which is basically let's say it has come up with a totally different idea altogether, which has created a need which has never been created, let's say. So would you look at it first and wait for the right time to get in when it starts making profit, or how would the process be like when for you to basically invest in that particular company?
So if you look what I said before, one of the top things that I look for in a business is the ability for that company to grow regardless of what's happening in the economy. For a company to be in that stage of its life cycle, it's typically because that company is going after a market that is rapidly growing and the company is in high growth mode. When a company is early on in its development, and you just said it could be 3, 4, or 5 years, it could be 20 years that a company is in this stage for. When a company is going after a market opportunity, the management team is often not focused on the bottom line at all. It is completely focused on scaling the enterprise and chasing customers and revenue. Under that situation, it's very common for the financial statements of that business to look terrible on a trailing basis, right? They typically show big bottom line losses. They're free cash flow negative because all resources are deployed towards scale and growth. And the only thing that you can really judge their success on is what's happening to the top line, period. When that happens, I am not going to shy away from investing in companies like that because Amazon was a sensational buy at any point over the last 25 years, and it's been in that growth stage of life for the first 20 years. At any point during that 20 years, Amazon was a fantastic buy, even though the bottom line results were negative that whole time. So I don't shy away from that at all. However, I do think through before I put capital into companies like that, what stage of growth is it in? How likely do I think, what's a reasonable odds that this company can achieve profitability? How much can I make if I'm right? And how much can I lose if I'm wrong? And I just know if you're going to invest that way, you're going to be wrong a lot. A lot. You are going to be wrong a lot. Let's say 80% of the time you're wrong. That's what you can expect if you're investing in unprofitable, fast-growing companies. However, it doesn't matter that you're wrong 80% as long as you occasionally buy and hold the next Amazon. You occasionally buy and hold the next Netflix, right? That's what really, really matters if that's your style of investing. So when I approach if I'm making that kind of investment, the way that I control my risk is just by allocating less to that company on day one. In my portfolio today is a company called Nanox Imaging. The ticker symbol there is NNOX. When I made that purchase, they had no FDA approval. They had no revenue. It was a hyper speculative business, right? I was not only believing that they were going to get FDA approval, but that they were going to successfully commercialize. Those are two huge hurdles for a company to get over, and success was so far from guaranteed. It's not even funny. However, I still made a very, very, very tiny purchase in the company because I surmised if I'm right, and if
Mm.
management can do what it says it's going to do, I could literally earn a 20x return
Mm.
on this company.
Mm.
What are the odds of that happening?
Yeah.
10%? I don't know. Like, it's literally low. But I was still willing, I was still compelled enough by the long-term thesis for the company to put a tiny little capital into it. By the way, so far that thesis has not played out. So far, I've been that looks like it's going to be a dud investment, but I still think it was okay to make that investment up front, simply because I thought the upside potential justified the downside, the risk that I was taking on. So I'm not opposed to making high risk investments, so long as you allocate it appropriately in your portfolio.
Hmm. Yeah, so I mean, coming to the point that you made, right? So it's very, first of all, it's very difficult to figure out what will the next Amazon be, or what will the next Netflix be, or what will the next big thing be. At the same time, obviously, it's important also to place your bet on these high risk, high reward companies, or high risk, high reward stocks. So how do you basically analyze, first of all, that this company may be the next big thing in the future, and at the same time, how much of your portfolio are you basically betting on, so that you're not only taking a huge, I mean, you're taking a huge risk, at the same time you're also your portfolio does not suffer a lot if things go the other way.
Yep. So for the first question to answer in this question is to stop and just evaluate yourself as an investor. Ask yourself, what kind of investor are you? And just think of that on a spectrum. On one end of the spectrum, right, all the way on the risky side of that frame would be Mark Andreessen, a venture capitalist, right? The only thing that they are going after is 1,000 baggers, right? They don't care how many losers they buy. The only thing that they care about is, can we fund the next Uber? Can we fund the next Instacart? That's the only thing that they care about. That's one style of investing. On the complete opposite side of that would be a Warren Buffett style of investing. And it was, I want to invest in sure things. I want to invest in companies that are already fantastic. They are already gushing cash flow. Nothing has to change. And this company is going to do well. And I want to pay a low valuation for that stock. And so imagine that spectrum, and you have to ask yourself, where are you on that spectrum? If I had to judge myself, I would say, if you go to the middle, I'm more towards Warren Buffett than I am towards Mark Andreessen. That's me personally. That doesn't mean I don't speculate occasionally, but it's not a big part of my investing philosophy. So again, here's another great exercise that I did for myself. I looked at my portfolio and I said, I broke it up into sections, 3 different sections. Section 1 is the highest quality, medium growth companies that I can find. So that section would be Facebook, Amazon, Google, right? Big cash gushing companies that are doing extremely well, have a history of doing extremely well. And I personally want about 40% of my capital in those companies. Section 2 would be the next FANG stocks. So these are companies that are also big, growing. Maybe they're not fully optimized for profits, but they have a serious chance of being the next big company. A company that I picked up recently was like Roku, for example. Roku is going very, very quickly. Its stock, even though it's down hugely, has largely rewarded investors, but it is not yet focused on profitability, but it could be one day. So I want about 40% of my assets in those. So 80% of my capital, I want in either quote unquote sure things or high probability sure things. That remaining 20% is where I kind of do this is the speculating. I'm okay with buying things that are unprofitable. I'm okay with buying things that are high risk. I'm okay with taking far more risk with this small bit of capital, but in exchange, I want 10, 50, 100x return potential with this bit of capital. So that's how I think about it. And I think it's a good exercise to go through and for every investor to kind of come up with those dials themselves. But I've done that work and that's how I think about it. And if that 20% of my portfolio goes to zero, it's going to suck.
Mhm.
but I'm going to be just fine as
Yeah.
a financially, right?
Yeah. So when you're building your stock portfolio, right? I mean, there are plenty of industries that you're looking at, like and obviously, like diversification in itself is very important. So first of all, diversification in the sense that you're targeting, let's say, value stocks or growth stocks. How would you go about, like investing, or like putting your portfolio in that manner? And at the same time, what other industries that you would specifically target, or would you want to, like invest your money into?
Yeah, it's a very common way that investors stratify companies into growth versus value, growth versus value. I don't personally buy into that. I think both terms matter for every single company out there. Rather than thinking about them like that, I think about it more as the business development cycle. Every company that's on the S&P 500, like every single one, at some point was a startup. It might have been 20 years ago. It might have been 150 years ago, but that business at some point was a high growth startup. In that phase of its growth, of its business, it was growing very, very rapidly, and it was not focused on the bottom line profits. So the profitability of the company was not yet the focus. Eventually, it became a public company. It obviously became a member of the S&P 500. And the odds are good that now that it's become a member of the S&P 500, its growth rate has slowed dramatically. It's captured its market opportunity. It's defending its turf, and it's doing well. When a company enters that phase of its growth, where the growth rate slows dramatically, say to 10% per year or less, in that phase, I really focus on valuation. I really focus on valuation. If I was going to buy Coca-Cola as an investment today, the very first thing I would look at would be valuation, right? What kind of valuation am I paying for this business? Because I know with Coca-Cola, the growth rate is only going to be mid-single digit at best, right? So my return potential is really, really capped. For that reason, I'm super going to emphasize valuation. If a company was in the hyper growth stage, like say Nanox could potentially be, I don't even look at valuation. The only thing I care about is what are the odds that this company is going to execute on against its growth plan. Very, very low chances, but the valuation is not even a factor. It's like thing 50 that I look at and care about. So I think it's a spectrum, and I think of growth versus the value the same way. If a company is growing slow and will continue to grow slow indefinitely, I'm going to hyper focus on valuation. If a company has unlimited potential and could grow 30% per year for a decade, I'm really going to de-emphasize valuation. Now, you asked specifically about sectors. I think that some sectors have lots of winners in them, and other sectors have very few winners in them. My sweet spot tends to be technology, and technology is like a bucket term, and there's a lot of different areas of technology. I like software companies because they tend to be high margin, repeat purchase, have competitive advantages, tend to be run by their founders. So that's a great market. I like fintech companies in the financial industry. They fast growing financial companies, they tend to have a high, and I also like healthcare companies. Healthcare companies tend to be misunderstood by a lot of people, but they can really build out a good moat for themselves. You can find winners in every category, but it's just finding the category that tends to align with your investing philosophy. I tend to see those mostly correlated in tech and healthcare.
That was like a great conversation that we had. I mean, there's a lot that we can talk about right now, but I mean, we're running out of time right now. So I mean, on that note, I'd really want to thank you for being on the podcast and sharing your nuggets of wisdom with us. And I really hope that the listeners of the podcast will definitely find a lot of knowledge and a lot of learnings from this podcast. With that being said, could you please tell us where can our listeners find you on social media?
Sure. The easiest place to find me on social media is on Twitter. My name is @Brian Feroldi. If you're interested in learning more about the process that I go through for finding and evaluating stocks, we do that on my YouTube channel, and that is also my name, Brian Feroldi. And finally, if you're new to investing, new to the stock market, I wrote a book that is designed specifically for beginners. It's called, as you said, Why Does the Stock Market Go Up? And that's available at all major retail outlets globally.